The reason why Fed Chair Powell didn't want to commit to a December rate cut yesterday is pretty simple. A number of the FOMC committee members aren't yet convinced the weak labor market really is that weak. Sure, the numbers don't look good, there's a couple negatives in there, but they don't see enough to suggest that it's actually real. Well, Chipotle and Kraft-Heinz would like to answer them with a pair of very serious warnings about the state of the consumer economy. Now, Chipotle's shares fell by the most since 2012 as a result of their earnings and, more importantly, the forecast that they gave. The company's CEO, Scott Boatwright, just said bluntly, quote, "The consumer slowdown is really affecting our business in a meaningful way." And then he added that, quote, "A majority is a massive pullback of our core audience." And the company confirmed that millennials and Gen Z, they're simply suffering from unemployment and paycheck shrinkage. Food giant Kraft-Heinz echoed the same sentiment and then some. That company's CEO also didn't mince words when he said, quote, "We have now one of the worst consumer sentiments we have seen in decades as we go into the holiday season." And that's also what consumers themselves have said, and also what Americans have said they're being forced to do before even getting to the holiday. The conference board earlier in the week reported on their dismal holiday spending plans, which goes way beyond just Christmas shopping. It's what the board said about non-holiday spending that really sticks out. So some of the inflationists at the FOMC see negative jobs numbers and they think, well, these aren't huge negatives and there are a couple positives scattered around too, so maybe it's all just a big nothing. After all, the stock market and trade deals. Now, unlike tariff inflation, the evidence for the flat beverage curve, and more importantly, the consequences of the flat beverage curve, continues to pile up. While Jay Powell did not want to commit to a December rate cut today, history shows the choice is not his to make. Pringles rule interest rates, not Powell. What Fed Chair Powell said at his press conference yesterday not only sums up the views or really just the suspicions of a number of FOMC committee members, especially Kansas City's Jeff Schmid, who outright dissented against the rate cut. What Powell said actually states what a lot of people who are mesmerized by the stock market, what they're thinking too. What Powell said was, quote, "For some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market or see whether, in fact, that the stronger growth that we're seeing is real." And so there's this constant tendency to downplay or dismiss the bad economy and the numbers that go along with it. Economists kept derisively calling criticism of the economy over the last couple of years as a vibe session, even as all the evidence had shown the weakness was not only real, the very real consequences weren't limited to strictly the macroeconomic context. I mean, start with Chipotle. The chain put up yet another ugly quarter from one of younger America's favorites. So many politicians and officials want to dismiss the plight of younger generations because their struggles don't fit with the mainstream narrative. The economy is booming, don't you know? Just look at Wall Street. You wonder why socialism is so popular, especially among those generations. For their entire adult lives, and for Gen Z, basically their entire lives, they've been told the economy is awesome. I mean, just look at everyone getting rich on tech stocks and Bitcoin. And everywhere people look, that's the message being sent all across the mainstream. This sucker is booming, so shut up and stop whining. And this is an enormous mistake. In fact, people in the political center and on the right, especially on the right, they need to take a hard look at the economy for why socialism is so popular. They dismiss it as a bunch of indoctrinated, gullible youth. I mean, how else could one of humanity's worst ideas ever catch on the way it has? And the answer is staring everyone back squarely in the face. If you've been told your whole life this is a booming economy, you'd be looking for alternatives too. If this is the best that capitalism free markets can provide, give me something else. That's the message, and that's also the answer. This is not the best that capitalism and free markets have to offer. So stop saying the economy is booming and start getting to work fixing it. Stop listening to the inflationists over at the FOMC who think, what's the big deal with a little bit of job losses? And start listening to people and companies like Chipotle when they tell you this is not a healthy economy. Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold, and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video. So what happened this morning? Quote, Chipotle Mexican Grill shares plummeted after the fast casual chain cut its outlook for the third time this year as diners pulled back from eating out, a fresh warning sign for consumer spending. The burrito chain now sees sales for the full year slipping in the low single-digit range from a year earlier. It had earlier projected that the performance would be flat, so already a downgrade there. And in the third quarter, comparable store sales rose slightly but still fell short of Wall Street's expectations. And according to CEO Scott Boatwright, as I said, the consumer slowdown is really affecting our business in a meaningful way. It's clear where this economy is really coming down hard. As always, it's the lowest income cohorts. They blame inflation, but that's not really the issue here. It's always jobs and incomes. Before this year, that had meant not enough income growth to keep up with price changes from during the supply shock. Not enough jobs either, by the way. This year, though, there's the added negative of outright negative jobs on top of everything else. Even if it isn't an overwhelming flood of layoffs, does anyone rationally believe that somehow makes it meaningfully better? The economic damage is still being done and it's still piling up. And with fewer jobs and job opportunities, consumers have to keep pulling back a little here and a little more there, and it just adds up. It adds up a lot. People notice. They feel it. You say, so what if they can't buy an extra burrito bowl? What's the big deal? It's that in an actually healthy economy, so many people wouldn't have to cut back like that. In pure macroeconomic terms, this completely flies in the face of the idea that's put forward by the stock market, and up until recently, Mr. Jay Powell himself, even if certain members of the FOMC today aren't fully convinced. Notice, however, as I pointed out yesterday, for all the bluster over not being sure, they all voted, save one guy, for the rate cut anyway. So while the FOMC might not be sure the economy really is weak, what's left mostly unsaid is that even the inflationists know more likely than not it actually is. They just want a little bit more proof. So let's go back to Chipotle, or in this case, Bloomberg's summary of the chain's plight. At Chipotle, the company saw a broad pullback in visit frequency across all income cohorts, but lower income consumers were particularly strained. About 40% of the company's customers come from households that make less than $100K, and that income cohort is significantly cut back on eating out due to concerns about the economy and inflation. Again, it's not inflation, it's about lack of income being able to pay for price changes. Boatwright said that customers in the late 20s and early 30s are, quote, particularly challenged due to unemployment, student loan debt, and slower wage growth. In political terms, dismiss these people's concerns at your and my own peril. Stop denying their struggles and start trying to understand them. Go beyond just the macroeconomic picture to the bigger picture beyond. And it wasn't just Chipotle. Kraft-Heinz reported lower third quarter sales and cut its full year outlook, citing worsening consumer sentiment and buyer resistance to food inflation. Quote, we now have one of the worst consumer sentiments we have seen in decades as we go into the holiday season. That's according to Kraft-Heinz CEO in a company earnings call. The consumer negativity and the sentiment has extended longer than we had originally expected because they all expected it would be about just tariffs and tariff trade wars. In the third quarter, net sales for the company's North America division fell 3.8%. And the company also said it's facing impacts from ingredient inflation, particularly for meat and coffee. It wasn't just sales that fell, volumes dropped too, further explaining why, first of all, the labor market is weak, and second of all, there is not now, nor will there be, tariff inflation. Are you listening, everybody on the FOMC? Companies are being pressed by rising costs, but are finding if they even bother trying to pass them on to customers, volumes drop. That's the opposite from inflation. And even acknowledging this economic reality, Kraft-Heinz CEO further added, quote, while the operating environment remains challenging, We're seeing improvement driven in part by targeted investments we're making to deliver superior and affordable products to our consumers. Affordable. An economy where big companies have to constantly figure out how to make what they make affordable is not one that's in good shape. In most cases, especially for smaller firms, making things affordable means trimming costs, which means trimming workers. The more businesses make goods and services, it's not just goods, the more they try to make goods and services more affordable, the more unemployment there's going to be, the more they have to try to make everything even more affordable than before, leading to still more unemployment, and the economy and the labor market gets stuck in a perpetual vibe session downturn. All the while stocks soar, American workers rightly go bitter with resentment, and the younger ones start believing in the bullshit spouted by socialists. After all, younger Americans can actually see the bullshit about this economy. Right now, there is far more credibility as far as a lot of young people are concerned on the socialist side. An economy divided against itself just will not stand. Eventually, it'll start to succumb to the fallacies of collectivism. And all of this just in time for Christmas. If there's one constant, it's that Americans have been consistent all year in their assessment of the economy, and especially coming from the labor market. And what's equally important in terms of sentiment, it's that consumers' views have vastly diverged from stocks. Share prices, or at least some share indexes, have soared from the bottom in April as if the trade war was the only macroeconomic negative, yet consumer confidence, which had initially plunged with stocks into April, only came back a little bit from those lows and then spent the summer doing exactly what the CEOs of Chipotle and Kraft-Heinz have said. I don't think people really appreciate how dismal that has become and how widespread it really is. The Conference Board's findings from earlier this week really should have been a wake-up call, but the new highs in the stock market overwhelm every last bit of common sense. After all, the AI bubble is far more fun and alluring. Not only did they say American expectations are deeply in recession territory, their holiday spending plans have been worse than shelved. According to the Conference Board, preliminary data suggests that consumers' holiday spending will be down this season compared to last year. Notably, consumers expect to spend a whopping 3.9% less on gifts and an even worse 12% less on non-gifts. And all of those are just in nominal terms, which means it's even worse in terms of volumes. When asked what will be driving their spending decisions over the upcoming holidays, consumers most frequently cited promotions and getting the most out of every dollar. These are not signs of a healthy economy. In addition to promotions, consumers also indicated that they will be likely buying fewer goods if the price of imported items is inflated by tariffs. And we already know that most retailers, the vast majority, are thinking in exactly the same way. We know that because of what they're doing, or in this case, what they're not doing. They refuse to announce any plans to hire seasonal workers. That's how confident they are in the consumer economy and the fact that the jobs market number might not be real enough for the FOMC. According to Challenger Gray and Christmas at the start of this month, right when seasonal hiring should have been ramping up, it was instead almost entirely absent. It was shockingly absent. The number of planned hires tracked by Challenger was just 1/4 of what it had been at the same point last year. 1/4, 25%. And as I said when the data came out, some retailers they'll end up hiring some of the people before the season's out. But the fact that almost none of them were willing to commit and announce their commitments earlier in the year showed you everything you needed to know about how retailers are leaning as far as the all-important Christmas season is concerned. Retailers are gravely concerned. Same as Kraft-Heinz CEO. Remember, what he said was, we now have one of the worst consumer sentiments we've seen in decades as we go into the holiday season. But tell that to a minority at the FOMC. Well, you don't need to. Reality is going to, which is why the Pringles can is in charge of interest rates, not Jay Powell, or Jay Powell's political attempt to corral enough votes at the FOMC. It's not about the December rate cut or what people think about the December rate cut today. It's about what we're seeing across all of these data points, including the Federal Reserve's own statistics and data and evidence on consumer expectations. It tells exactly the same story. FRB&Y's survey of consumer expectations showed a massive drop in job finding expectations for the month of August, which was way down to 44.9, a record low, worse than even the pandemic. But that number not only rebounded just a few points in September, from a record low, worse than the lockdowns, to just barely almost a record low equal to the lockdowns. So it didn't really get better in September. And the data mirrors what consumers have been saying, and it aligns only too well with the government data, the hard data, like the utterly dismal JOLTS hiring estimates. There are no jobs available. That is not normal. That is not a healthy economy. That's not what stock markets are actually pricing. So some FOMC members wonder if the bad economy is real. The evidence consistently shows that it is, and then some. Now, at the end of his presser yesterday, Chair Powell did acknowledge to an extent this Pringles flavored reality. Going off script a little bit, what he said was, quote, "If we do wind up resuming rate cuts, at some point we will, but some point, I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation on its way to 2% or at 2%. So that's what we're all trying to do, and we're doing it under quite challenging circumstances and doing the best that we can. So rates are coming down. Powell's going back into the Pringles. Neither he nor anyone else at the FOMC can say for sure right now they're willing to support doing so in December, simply because they aren't yet sure the bad economics, which keep coming up from all over the place, really are as bad as they do appear to be. Whether it's sentiment data from the Fed, holiday spending from the Conference Board, or Chipotle's, quote, "the consumer slowdown is really affecting our business in a meaningful way," with a, quote, "massive pullback of our core audience," there's more than enough to lean hard in that direction, toward the weakness. What's really happening here is that the remaining tariff inflation holdouts are still holding out because they will need absolutely overwhelming data. They need to see Amazon's layoffs replicated by every large company, big and small, up and down the economy, before being fully convinced. That's not just bad analysis, it's bad economics. The forgotten souls of the forgot how to grow economy are not going to stay forgotten forever. Their concerns are very real, and either start understanding them or get out a fiddle and start playing for the fires. One other way that we know this stuff in the real economy is real is because of the effect that it's having on credit markets and, to an extent, in money markets. Went over those details, the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.